Insurance is regulated by the individual states. The move to modernized insurance regulation is being driven in part by the globalization of insurance services. Some large US companies that operate in other countries support the concept of a federal system that provides one-stop regulatory approval, while others believe the merits of a state system outweigh the virtues of a single national regulator. As a result of discussion about the merits of each system, states are making it easier for insurers to respond quickly to market forces. State monitor insurance companies' solvency. One important function related to this is overseeing rate change, rate making the process of calculating a price to cover the future cost of insurance claims and expenses, including a margin for profit to establish rates. Insurers look at past trends and change in the current environment that may affect potential losses in the future. Rates are not the same as premiums. A rate is the price of a given unit of insurance. Of earthquake coverage, for example, the premium represents the total cost of many units. If the price to rebuild a house, if the premium would be rate vary according to the likelihood and potential size of loss. Using the example of earthquake, insurance rates would be higher near a fault line and for a brick house which is more susceptible to damage than a frame one. While the regulatory process in each state varies, three principles guide every state rate regulation system: that rates be adequate to maintain the insurance company solvency but no excessive, nor not so high as to lead to exorbitant profits, nor unfairly discriminatory. Price difference must reflect expected claim and expenses differences. Recently in auto and home insurance, the twin issues of availability and affordability, which are not explicitly included in the guiding principles, have been assuming greater importance in regulatory decision. In line with these principles, states have adopted various methods of regulating insurance rates, which fall roughly into two categories: prior approval and competitive. This does not mean there is no competition in state using a prior approval system. Most approved rates in prior approval states are the rates used, but in some cases, particularly in commercial coverage, companies compete at rates below these approved ceilings. Regulation modernization increasingly, even in the most regulated states, officials are relying on competition among insurance companies to keep rates down and are more modernization and ये type box निकाल दो type type of state rating laws. Prior approval, the insurance must file rates, rules, etc. with state regulator depending on the statute. The filing becomes effective when a specified waiting period elapses. If the state regulator does not take a specific action on the filing, it is deemed approved automatically, or the state regulator formally approves the filing. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. Modified prior approval. This is a hybrid of prior approval and file and use laws. If the rate revision is based solely on a change in loss experience, then file and use may apply. However, if the rate revision is based on a change in expense relationship or rate classification, then prior approval may apply. A state regulator may disapprove a billing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. Flex rating. The insurer may increase or decrease a rate within a flex band or range without approval of the state regulator. Generally, either file and use or use and file provisions apply. Generally, the insurer must file rate increases or decreases that fall outside the established flex band with the state regulator for approval. Typically, prior approval provisions apply. The flex band is set either by statute or by the state regulator. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance, file and use the insurance must file rates, rules, etc. with the state regulator. The filing becomes effective immediately or on a future date specified by the filter. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. Use and file. The filing becomes effective when used. The insured must file rates, rules, etc. with the state regulator within a specified time period after first use. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. State prescribed. The state regulator determines and promulgates the rates classification forms etc. to which all insured must adhere. Insurance are usually permitted to divide from the set from state prescribed rates classification forms etc. with the approval of the state regulator. No file record maintains. The insurer need to not file the rates, rules, etc. with the state regulator. Rates, rules, etc. become effective when used. The state regulator may periodically examine insured to ensure compliance with the law. Generally, there are record maintenance requirements under which insurers must make their rating system available to the state regulator for examination. A state regulator may order discontinuance of the use of the material at any time. If it is not in compliance with the law, the state regulator normally must hold a hearing to establish non-compliance. Reinsurance. Reinsurance is insurance for insurance companies. It is the way of transferring or ceding some of the financial risk. Insurance companies assure in insuring cars, homes, and business to another insurance company. The reinsurance, a highly complex global business, accounted for about 9% of the U.S. property casualty insurance industry premiums in 2008, according to the Reinsurance Association of America. The reinsurance business is evolving. Traditionally, reinsurance transactions were between two insurance entities, the primary insurer that sold the original insurance policies and the reinsurer. Most still are primary insurers, and reinsurers can share both the premium and losses, or reinsurers may assume the primary company's losses above a $10 limit in return for a fee. However, risk of various kinds, particularly of natural disasters, are now being sold by insurers and insurers to institutional investors in the form of catastrophe bonds and other alternative risk spreading mechanisms. Increasingly, new products reflect a gradual blending of reinsurance and investment banking. After Hurricane Adra bid solutions, Southern Florida in 1992, causing is insured losses. At the time, it became clear that U.S. insurers and seriously underestimated the extent of their liability for property losses in a major disasters until Hurricanes Andrew. The industry had bought 8 billion was the large possible catastrophe loss. Reinsurers subsequently reassessed their position, which in turn caused primary companies to reconsider their catastrophe reinsurance needs. The storage and high cost of traditional catastrophe reinsurance participated by Hurricane Andrew and declining interest rates, which set investors looking for higher yields, promoted interest and securitization of insurance risk among the precursors to catastrophe bonds and other forms of securitization were contingency financing bonds such as those issued for the Florida Windstorm Association in 1996, which provided cash in the event of a catastrophe but had to be repaid after a loss, and contingent surplus notes and agreement with a bank or other lender that is the event of a mega disaster that would significantly reduce policyholder surplus. After a contingent surplus notes an agreement with a bank or other lender that in the event of a major disaster that would significantly reduce policyholder surplus, funds would be made available at a predetermined prices fund to pay for the transaction should money be needed, not hamper our insurer ability to write additional insurance. In addition, there were equity puts through which an insurer would receive a sum of money in the event of a catastrophic loss in exchange for stock or other options. The catastrophe bond is a specialized security introduced in 1997 that increase insured ability to provide insurance protection by transferring the risk to bond investors. Commercial banks and other lenders have been securitization mortgage for years, freeing up capital to expand their mortgage business. Insurers and reinsurers issue catastrophe bonds to the securities market through an issue known as a special purpose reinsurance vehicle set up specifically for this purpose. These bonds have complicated structures and are typically created offshore where tax and regulatory treatment may be more favorable. SPVRs collect the premium from the insurance or reinsurance company and the principal from investors and hold them in a trust in the form of US or other highly rated assets using the investment income to pay interest on the principal. Catastrophe bonds pay high interest rates, but if the higher if the trigger event occurs, investors lose the internet interest and sometimes the principal, depending on the structure of the bond, both of which may be used to cover the insured disaster losses. Bonds may be issued for a 1 year term or multiple years, often three. The field has gradually evolved to the point where some investors and insurance companies insurers are beginning to feel comfortable with the concept, with some coming back to the capital market each year. In addition to the high interest rate, catastrophe bonds pay their attraction to investors is that they diversify investment portfolio risk, thus reducing the volatility of returns. The returns of and most other securities are tied to economic activity rather than natural disasters. Catastrophe bonds have evolved into a multi-billion dollar industry, though coined by reinsurers. Primary insurers now frequently sponsor new issues. In addition to catastrophe bonds, catastrophe options were developed, but the market for these options never took off. Another alternative in the exchange of risk, where individual companies in different parties of the world swap the certain amount of losses. Payment is triggered by the occurrence of an agreed upon event at a certain level of magnitude. Residual markets in a normal competitive market insurers are free to select from among people applying for insurance those drivers, property owners, and commercial operations they wish to insure. They do this by evaluating the risk involved through a process called underwriting. Applicants who are considered high risk may have difficulty obtaining insurance through the regular voluntary market channels. The team highly risk applies to individuals of individual business with a poor loss record due to inadequate safety measures. Certain kinds of business or professions where the nature of the work is hazardous or where the risk of lawsuits in high and specific locations where the risk of theft, vandalism, or severe storm damage is substantial. To make basic coverage more readily available to everyone who wants to or needs insurance, special insurance plans have been set up by state regulators working with the insurance industry.